Good afternoon, everyone. This is Steve Janikowski, Chief Executive and Chief Investment Officer with Brower & Janikowski. We recorded this webinar shortly after our client event on April 28th, our bond investors settling for a losing strategy, in the hopes that it would help those who were unable to travel to the event at least gain the same background that we showed for the clients who were able to attend. Let's first review the purpose of bonds. Why do we have bonds in the portfolio? Bonds are an investment that we use for safety and liquidity. They're our first source of cash if we need to liquidate something. They generate income. And most importantly, they're diversifiers, and they help balance out the portfolio. They act as shock absorbers to balance out the more volatile growth investments such as stocks. As a refresher, let's look at how bonds work. Bonds are fixed income investment vehicles. And what that means is once you purchase a bond, you've locked in its current yield. And bonds are very interest rate sensitive, meaning that if interest rates go up, because you've fixed that yield, your bond may no longer be as competitive, and so the value would be less in the marketplace to make it competitive. Vice versa, if interest rates go down, you had locked in a higher yield than the current yields, and therefore your bond would be more valuable. Let's take a look at where interest rates have been. This chart is interesting because it shows over a 50-year perspective, showing back to the 50s where bond yields were down to about 2% for the 10-year U.S. Treasury bond, climbed all the way up to about 15.5% in 1981 as we went through an inflationary period. And then after we went through a disinflationary period, Paul Volcker, who was the then Federal Reserve Chairman, who waged war on inflation, raising interest rates way up through 1981, dropped rates dramatically, allowing us to go into a declining interest rate environment where bonds were magical investments, generating returns almost as high as a stock market. And here we are again in 2015 with yields actually below where they were in the 1950s. Question on investors' minds are, where are bond yields likely to go now? Are they likely to stay where they are, or are they likely to go higher? Most investors are betting that bond yields are going to go higher, and they worry, what does that mean for bonds? Are bonds a bad investment? And that's what we're going to look into today. So I classified most investor concerns that I've had speaking and meeting with clients. The first one is the Fed Reserve will raise interest rates. Doesn't that mean my bonds will go down in value? And if that's the case, and it's certain, shouldn't I sell my bonds and put my money in a money market fund or some type of cash investment? The problem with this strategy is that this bonds, interest rates are going to go higher and bonds are going to go down in value has been going on for almost 4 years now. And bonds have not gone down in value, and yields actually have gone down and bonds have gone up. So someone who had sold their bonds and sat in a money market fund yielding less than 0.25% would have missed out on some fairly juicy bond yields. Last year, the bond yields were up to 3 to 6% total return. And the years prior to that, bonds also were very good investments. The second concern is, well, if rates are so low, is there a way that I can increase the yield on my portfolio? And here the concern is for people, especially on fixed income, who are used to or need to generate a certain amount of income on their portfolio to stretch for yield by investing more in high yield or junk bonds and emerging market bonds, which have higher yields. But the risk or the potential bad outcome is that if they concentrate too heavily in these risky sectors, and when interest rates do eventually go up, the price of these bonds are going to go down significantly because the higher risk bonds tend to be much more volatile, closer to is the volatility of stocks. And the third investor concern is what I'd call confusion. Not sure what's going to happen, and therefore it leads to inertia or doing nothing, or sticking with a plain vanilla strategy such as just leaving your money in a Vanguard Total Bond Market Index Fund because that's the broad bond market. And the problem here with this strategy is if you're in a plain vanilla strategy, as I'm going to show in a few moments, there are capital losses when interest rates do start to rise. And secondly, if you're not prepared to take advantage of opportunities, there will be opportunities along the way because there will be dislocations, meaning things are going to go bad, such as when the price of oil collapsed late last year, there was concern that some of the energy companies were going to go out of business and default on their bond payments. About 13% of the high yield market is made up of energy related companies. So their concern was that these bonds might default. Well, the entire high yield market plummeted, throwing out the baby with the bathwater. Even though 87% of high yield bonds were not energy related, they went down in sympathy with the rest of the energy bonds. This was a great opportunity to buy high yield bonds at depressed prices. Same true with corporate bonds because they reacted in a similar fashion. Let's take a look at what's going on in the global credit market landscape. So I broke it down into 4 areas: economic growth, slower contracting, and this is on a global basis. All areas of the globe have been contracting or slowing. Even China, which is one of the faster growing countries, is in a slowdown mode. Inflation, very low around the globe except for a few exceptions, such as Brazil. Central bank policy. Global central banks are mostly in an aggressive easing stance, lowering interest rates, going on their own forms of quantitative easing programs, similar to the quantitative easing program that our Fed Reserve did. And for those of you who are not familiar with that program, quantitative easing was a program where the Federal Reserve borrowed vast amounts of money, purchased bonds in the marketplace, which took them out of circulation, and it had the effect of reducing interest rates and causing asset prices to skyrocket. That would be bonds, stocks, and real estate. And lastly, bond yields. Yields on a global basis have continued to decline, so they're very low and they're still declining. In some cases, they're even negative. Believe it or not, some bonds have negative yields. And you may wonder, well, how could that be? It's just because the demand for bonds has been so great that the price has exceeded the underlying value. So where a bond had a very low yield, you're paying much more than it's worth, and when it matures, you'll get less back, so your effective return is negative. They're calling that a negative yield. I mentioned that global central bank monetary policies have been in an easing mode. This chart is interesting because it shows you on a pictorial basis how that looks around the globe. All the green areas are countries which are in an aggressive easing stance, meaning they're lowering interest rates or doing some other type of monetary policy to make easy money and trying to stimulate their economy. There are only 2 countries which have rising or tightening monetary policies. Those are the countries in red, Brazil and the Ukraine. Notice that the United States is not in green, and that's because we ended our quantitative easing and we're not currently reducing our federal funds rate. However, I would argue we are still in a very easy money monetary policy situation, simply because the Fed Reserve has not changed it, and we've got money sloshing all over the system. The U.S. economy, which is maybe a more focus for you, we have very slow growth. We have not had, coming out of the recession, the Great Recession of 2009, have not had robust growth as you normally would. Inflation has stayed very low. Interest rates have continued to go down and stay very low. And we've had a strong U.S. dollar. I'll explain in a few minutes why a strong U.S. dollar is both a good thing and a bad thing. This chart shows how the economy is growing. The green line is the trend line, meaning the almost the average of how our economy has been growing. That is gross domestic product, or GDP. So we're measuring the real, that is after inflation growth of GDP. The trend line is about a 3.1% annual growth rate. And you can see the blue line is the actual growth rate. And notice since 2009, the blue line dipped below the trend line, meaning we were growing slower than our normal or our average. We've been growing at about a 2% clip. And this is interesting because the whole idea behind quantitative easing and the monetary easing was to drive growth in the economy. Well, it hasn't done that. It may have gotten us out of recession, but this is one of the weakest recoveries on record, and it has not driven growth. What it has driven is asset value increases, stocks, bonds, real estate. Inflation, as I mentioned, is very low. You can see, as I mentioned, where Paul Volcker came in and squished inflation with his hike in interest rate policy and his war on inflation. Back in 1980, rates peaked and then have steadily gone down since, and we're still in a declining or disinflationary environment, which is good. It's actually a very good thing, and what's really odd is I'm sure Volcker scratches his head because they were fighting inflation. Inflation was the enemy back in the 60s, 70s, and since then, disinflation was viewed as a very positive thing through the 80s and the 90s and the 2000s, and now low inflation is perceived to be the enemy, and they're actually trying to increase inflation. I'm not sure that's the correct approach, but that's what the policymakers think is the right solution. Federal funds rate is the money that the Fed Reserve pegs that charges member banks, and notice it's gone up through the 60s, 70s up to 80, and then gone down again. This mirrors what has happened with Treasury bills in all fixed income investments generally. So in the bond market's generally going to follow where the Fed funds rate goes. So the Fed really does dictate where the bond market's going to go and where interest rates are going to go. And notice they've kept rates at the far end of the right end of the chart near zero. Since 2009, it's been zero and has not gone up. And if you look historically over the last 50 years, this has never been the case. We have never had such a weak economy that we've had to keep rates near zero for such a long time. I showed this chart earlier, but thought it'd be worth showing again. Notice how the 10-year Treasury, which is a representative of the overall bond market, has gone down with the federal funds rate. What's significant about this is that the 10-year Treasury is used to peg mortgage rates. So you may recall it was a great time to lock in bond yields in the early 80s. You could really lock in some very, very attractive rates of return. And also, remember how high mortgage rates were back in the 80s. People were paying 13% for mortgages. Well, one of the great benefits of these reduced rates is it's made housing and borrowing very, very cheap. So having mortgages in the 3 to 4% range instead of the 13% range has made housing very affordable, and also has driven the whole real estate market. That may begin to turn around at some point. I mentioned the dollar, US dollar. Well, you can see that the dollar was in a long-term decline from 2002 all the way down to 2012, and has recently started a resurgence, going up relative to a basket of foreign currencies. The dollar is the world reserve currency, meaning most commerce is based on the dollar. And this is a good thing for us because it allows us to borrow money on a global basis to finance our deficit. The bad thing about a strong dollar, however, is that it makes U.S. manufacturing less competitive in the global marketplace. So the estimate is that the strong dollar is actually shaving as much as 1% off our GDP growth rate. So given that we have a low growth rate to begin with, you recall the previous chart, we're growing at about a 2% clip. Well, we don't have a lot of wiggle room here. If we're growing at 2%, shaving off 1% brings us down to fairly low levels, closer to what you'd perceive as a recessionary levels. The one offset to this dollar increase, though, is oil prices. As oil prices have come down, that actually acts as a boost because it's almost a tax cut on a global basis. So then we get to the $64 million question, which is when will the Fed Reserve raise interest rates? This is the question on everybody's mind. The Fed has indicated that they may raise rates at any time. Most of the prognosticators and the financial luminaries are estimating somewhere between June and September of this year. We think that the Fed really doesn't have justification to raise rates for all the reasons we talked about earlier: low inflation, low interest rates, low growth, no sign of fast growth on a global basis anywhere. And one of the biggest causes of inflation, which is what would spook the Fed, are wage increases as the labor market tightens. Well, the labor market is slowly strengthening, but it's not tightening yet. And so we don't even have wage inflation as being a problem. So I don't really think the Fed has the justification to raise rates. However, they also don't want to spook people because they really want to keep asset values up, that is the housing and the real estate and the stock market. So they want people to feel optimistic. So they want to show optimism that the economy is healing. Raising rates, as they said they would be a sign that the economy is strengthening and can stand on its own 2 feet. So we may see a token rate increase by the Fed Reserve, and they will test the waters to see if they can continue to raise rates without spooking the economy and causing us to topple back into a recession. Where we should be, federal funds rates at this point, they're artificially depressed. Federal funds rate should be in the 2.5% to 3% range right now. If Janet Yellen, the current Fed chairman, could wave a magic wand while we were all asleep, I'm sure she would love to wave a wand and have federal funds rate magically appear at 3%, and nobody be any the wiser the next morning when they woke up. Although the investing public is vigilant at this point, watching every little move that the Fed makes, and so the Fed's a little nervous about spooking the market. This chart's interesting because it shows what the Fed has published as its likely scenario for raising the Fed funds rate. You see the dotted purple, orange, and blue lines on the far right side of this chart show where the Fed Reserve has indicated federal funds rates may be raised over the coming several years. The dotted green line is interesting because it reflects what the market actually thinks the Fed will do. This is the futures market's expectations, and the futures market, which is likely more accurate read on where the investing public thinks rates are likely to go, indicates that rates are not going to climb very quickly, maybe 2% over the next 3 years. So where do we stand now? Bond yields are low. The question is there value? Do bonds still make sense? Should I be invested in the bond market? And if so, which bonds should I own? Let's take a look at the overall bond market. The global bond market has been growing over the last 20 some odd years. Notice this chart just shows the growth in the number of issuance of bonds. The gray bottom one is U.S. bonds, currently at $35 trillion in bonds. Developed minus the U.S., these are developed countries. That's the blue area, it's 43 trillion. And then the purple area are emerging markets or emerging economies, 14 trillion, almost 1/3 of what the total U.S. bond market is. So it's a very, very large developed market. But where are the opportunities? Well, government bond yields are low, mostly. This chart shows that most of the U.S. and most of the developed economies have very, very low bond yields. Lows such as Japan of 0.3%. The U.S. is a little over 1.5%. Germany is only a 0.5% yield. Then you get to some of the emerging markets. Some of the trouble spots such as Greece and Russia have very high yields. And India, which is still an emerging economy but much more solid, about a 7% yield. And these are some of the yields you'll find here in this table. And I also want to explain something that we use as a measure of risk, which will help in this solving the dilemma of what to do about bond investments. So on the far right column, you can see the yield for various country aggregate bond indexes. So these are not just government bonds, but all bonds in the trading in an economy. And as you can see, they're all very low, except when you get down to the emerging markets. Let's take the U.S. for a moment to explain the concept of measuring risk. So the U.S. Top line, that's the aggregate bond index in the U.S. Those are basically almost all bonds traded in the United States. It's called the Barclays Aggregate Index. And you can actually buy the Barclays Aggregate Index in a proxy format through the Vanguard Total Bond Market Index Fund, which is what I call the plain vanilla bond strategy. So if you purchase that, you would be purchasing a yield of 2.1%, and then you have a duration of 5.5 years. Now, what the heck does that mean, a duration of 5.5 years? It means when you look at the maturities of the average maturity of the portfolio plus the bond coupons that are going to be paid out, the total elapsed time for you to receive your total investment, that is the maturity of the bonds plus the interest payments, is 5.5 years. Now, why on earth would we be interested in that number? Well, because we can use it as a determination of how much interest rate risk is in a bond investment or a mutual fund, bond mutual fund. So 5.5 years roughly means that if interest rates go up 1%, that 5.5-year duration portfolio will decline by the amount of the duration as a percentage. So 5.5 loss of principal. Vice versa, if interest rates go down 1%, that portfolio or bond would go up 5.5%. So let's think about what happens with the Vanguard Total Bond Market Index Fund. We buy it, we're earning 2.1%. Interest rates go up 1% over the course of a year. So we earned 2.1, but we lost 5.5% principal. Our net return is the sum of the two, or we've lost 3.4%. Doesn't sound super attractive. And it gets even worse in some of the other economies. Look at Japan. You can, for the privilege of earning 0.4%, you're taking a duration risk of 8.3 years. So if interest rates go up 1% in Japan, you earned 0.4, but you lost 8.3. That does not sound like a healthy risk-reward quotient. U.S. bond market, you can see we have broad coverage of the various types of bonds. Treasuries are some of the lowest yielding, but also we have broad investment in the portfolios in mortgage-backed, some municipal, corporate, high yield, and floating rate, and some of the other types of bonds as well. So there are different bonds in there that have higher yields than treasury bonds that are attractive. So what does a bond investor do where we're not sure what interest rates are going to do? We know they're going to go up, we just don't know when. And this is the last bottom of that chart I added to the previous chart you saw. It's in red, which I think the question bond investors should be asking is, can I increase my yield while protecting my capital? And how do I optimize my investment in bonds? And the answer, the decision, I believe, lies in three things. Number one, diversify your risk. We won't be buying just one geography or one type of bond. Manage interest rate and credit risk. What does that mean? It means, we talked about duration a few minutes ago, keep the duration low. So if bonds interest rates do go up, reduce the amount of principal risk of the bond portfolio. Credit risk means we can still have bad things happen around the world, and protecting against blow-ups as we had in 2008 and 2009 by owning primarily high-quality bonds. And lastly, capitalize on opportunities created by headwinds and dislocations. What does that mean? Well, remember I mentioned that oil collapsed late last year. Well, it was an opportunity to acquire some high-quality, high-yield bonds at depressed prices with higher yields. Same is true with emerging markets bonds. And we actually did acquire some high yield and some emerging markets bonds because emerging market went down in sympathy late last year as well. So this is no longer going to be a buy and hold bond market. It's going to require tactical changes in portfolio to manage as interest rates start to go up. What do? Well, you're going to reduce duration even further, and we'll talk about that in just a couple minutes. So let's talk about how we've actually allocated your portfolio. What are we looking for? Well, we don't know for sure when interest rates are going to go up. They haven't gone up the last 4 years. I think they're unlikely to go up in any meaningful way that's going to disrupt the bond market. So we really want to capture yield. We don't want to sit in the money market earning 0.25%. We'd like to maximize what we have, but with a quality bond portfolio. And we want to keep interest rate risk at a reasonably low level, because at some point there could be a hiccup, and at some point rates will start to go up. On the far left, the bars are the Vanguard Total Bond Market Index Fund, which we just mentioned, a duration of about 5.5, 5.6 years, and a yield of about 2 or 2.1%. The middle bar is how we've allocated our client bond portfolios. So notice the red bar duration is quite a bit less than the overall bond market, 3 years. So if interest rates go up, we have a 3% risk to principal, so about half the bond market. And we've been able to boost yield by investing in different segments of the bond market with higher yield. So we have a 3.3% current yield. One of the newer investments in client portfolios was the River North Double Line Strategic Income Fund. That fund has a yield of over 5.3%. And what's unique about it is, and I consider this an opportunistic purchase for your portfolio, is that the more than half of the portfolio is invested in closed-end bond mutual funds. And closed-end funds trade currently at a discount to their net asset value, meaning that the price we had to pay was approximately 90% of what they're worth. So we have a built-in 10% profit if and when it gets to what the bonds are truly worth. So it gives us a little bit of a cushioning if our interest rates go up, and also gives us some capital appreciation potential if that gap with the net asset value and the current price narrows. Going forward, we'll continue to actively manage your bond portfolio, monitoring very closely what is happening with interest rates and looking for opportunities. There will be additional blow-ups along the way. Things will go wrong and the bond market will react, and we'll look and see where there are opportunities that we can add to your portfolio opportunistically. And also, we're riding this sort of benign interest rate environment right now with almost half of what the bond market duration interest rate risk is. But as soon as a trend emerges where rates do start to go up, we will be more active and likely reducing the duration risk or interest rate risk in your portfolio fairly dramatically. And we can do that. We just don't see the need to do it right now. We've been talking about bonds, but there are other income strategies that we are incorporating in the portfolio in addition to bonds, and it's a complement also to the growth strategies such as stocks in the portfolio. One of our favorite is MLPs, or Master Limited Partnerships. We're investing primarily in infrastructure MLPs, meaning these could be things like bridges, water, sewage, essential services, which, even if the economy is weak, are likely to do well. And also the energy ones, which are really quite appealing to us right now. We're not subject to the commodity risk or the risk of oil going up and down in price because we're not exploring, we're not drilling for oil, we're not exploring for oil, we're not trying to process oil, we're transporting oil, or we're storing oil or natural gas or other energy. Think of it as commercial real estate, where we own the facilities, others want to use those facilities, and they're going to pay us rent for that. So the MLPs will sign long-term leases for others to transport and store their energy. And these leases generally are 10 years or so and have inflation kickers. So if inflation goes up, then that lease rate in essence goes up. This chart's interesting. It doesn't show the yield of MLPs, but it shows the growth rate of the distribution or yield of MLPs. Notice the blue bars have had a relatively consistent increase year by year relative to the black dotted line, which is inflation. So in other words, the yields on MLPs are growing faster than the rate of inflation. Now, remember earlier I said bonds are fixed income investments. Their yields don't go up, so they lose ground to the rate of inflation. That's one of the reasons we love MLPs in the portfolio, because it augments what we're doing with bond investments by giving us an income stream that is increasing with the rate of inflation. So it's projected that for last year, here on the far right, that 2014 estimate of the increase for MLP yields would go up 5.7%. One of the MLPs that we're using in client portfolios, the Larian MLP Fund, again an energy infrastructure fund, currently has a yield of approximately 6%, and that yield has gone up and is likely to go up somewhere in the 5 to 7% range from last year's yield. So it's a very attractive investment, and also for the taxable portfolios, that 6% yield is in essence not taxed because of depletion and depreciation allowances. So it's a very attractive yield in a taxable portfolio. Another area we like are real estate investment trusts, or REITs. This chart just shows that REIT yields exceed U.S. Treasury yields on a consistent basis. The orange line are the yields of REITs, U.S. REITs, and the green line are U.S. Treasury, 10-year Treasury yields. And notice most of the time the orange line is above the green line, meaning the yield on REITs, U.S. REITs, has exceeded that of Treasuries. So again, this is another area where yields can go up. They're not locked in. And there's also some growth potential. So we consider these two areas, MLPs and REITs, as two attractive areas of part income and part growth in the portfolio, and another way of rounding out the portfolio or balancing and diversifying the portfolio so that we're not dependent on just one asset class. And there are other areas too, don't have time in this webinar to go through them, but certainly we'll cover them in additional client events or webinars. But there are some other strategies, alternative strategies that we are incorporating in your portfolio for yield and as shock absorbers for the eventual stock market correction that we're likely to see. So I'm going to sign out at this point, and I hope this was helpful. Hope you enjoyed the presentation today. And I hope that we see you at one of our future monthly client events. We plan to have these around the Bay Area. We alternate between the South Bay, San Francisco, the East Bay, and the North Bay, and try to pick topics that we think are timely and interesting to you, and try to keep them very tight. The topics and the entire event are designed to be exactly 1 hour, so you're in and out the door an hour later, and hopefully had a nice lunch and learned something useful. If you have questions on the presentation that I went through in today's webinar, call your financial advisor, and they'd be happy to walk you through any questions that you may have about the materials I covered. So thanks very much for listening, and we look forward to seeing you at one of our future client events. Take care. Good afternoon.